Hey, welcome everyone to a special event with CEO of Dario Health, Erez Raphael. Before we get started, just going to read this disclaimer. Story trading is not an investment advisor. Investing in securities involves significant risk of loss. We are recording this event. It will be available to our paid members throughout the week, and then we're going to be publishing it on YouTube next week. Real quick, you can go to storytrading.com, click on performance. You'll see that Dario Health, we've been on top of this from very early on, around $7. You can see all our VIP picks there and the performance, how they're doing. And also want to thank Erez and his team, including Rick, what's his last name, Erez? Rick Anderson. He also brought his product team once, has been very generous with his time, with multiple presentations already to our community. Our community knows Dario very well already. We know the story really well, so we're just going to jump into a Q&A with Erez today. So with that, all right. So what I wanted to focus on, Erez, again, thank you again for your generous time, was some clarifications on comments made on the fourth quarter conference call. One thing at first I wanted to point out is, I think you mentioned this in a recent interview, is I think the market has missed something you said in there regarding double-digit growth, both in your core business and in Upright. And, when I did the math on that, with the Upright acquisition closing on February 1st, it looks like a minimum of $4.9 million revenue. I know you're not giving guidance, but am I doing anything terribly wrong with the math there? Because if you look at the street estimates are 3.3 million, which, again, simple math, I'm coming up with a minimum of 4.9 million. Maybe Stifel Nicholas finally got it right this week with the $30 price target, but does that math sound about right the way I did that, with 2/3 of the Upright revenue coming this quarter?
Yeah, the short answer is that you're not terribly wrong. That's the short answer. The more complicated answer is that the two businesses together are very, so more or less aligned with the numbers that you said as a pro forma. However, when you recognize a formal revenue, you need to take only a subset of that, because the formal acquisition was announced, and then the definitive agreement was announced on January 26th, and it took us another week before we closed the transaction. So from an SEC standpoint, an audit standpoint, we cannot count in the January revenue when we are presenting the revenue. So I think that you are right, but at the same time, most of the analysts are also right to some extent. So the truth is somewhere in the middle.
I see. Okay, I'll leave that to my experts who are good with the accounting stuff to figure that out. So,
yeah, but just one more comment. I think that to give the overall picture, when we acquired Upright, the business of Upright was declining between 2019 to 2020. There was a COVID-19 issues. The business was running out of money and so on. What we did, and what I'm telling you now is public information, we injected a loan of 1.5 million into the business prior to the acquisition in order to be able to make this acquisition. We got them into a no shop, okay? And by injecting this capital, we started to turn around their business and bring it back to growth, okay? What investors are gonna see in Q1, and that was the point that I was trying to make, is that we're going to see a growth both on the Upright business between Q4 to Q1 and on Dario business between Q4 to Q1. And each of these growth together are going to be double-digit in percentage, which is something that on a pro forma base, very close to what you just mentioned at the beginning of your question. Mm-hmm. So you are right, you are not wrong.
Okay, very good, thank you. So I want another clarification. On the conference call, there was an analyst that was running the numbers. He asked you a question. I'm not sure if you understood him right. He was getting this 10% sequential growth, and I think he came up to, like, for the core business, 250,000 for the quarter. He annualized that. He's like, so it looks like you're getting $1 million revenue. This paraphrasing what the analyst said. Looks like you're getting $1 million revenue for all of the new employer deals combined that you had announced in Q3 and Q4 that started recognizing revenue in Q1. So the question was, is that about right? That the run rate for all of these, I think it was like 4 or 5 deals, is $1 million a year? And he said, yes, about $1 million, but that doesn't sound right. I'm not sure if you were saying $1 million per employer on average, or for all of those deals combined, it's only going to give you $1 million for the year.
So if I'm not mistaken, the overall range was somewhere. I mean, the overall range is somewhere between 800,000 to 1.5 million for all of them aggregated. But that's not the only accounts that we have this year. We will have more accounts. So just to remind investors, we have like I would say 3 different buckets from where we can generate revenue. Bucket number 1 is the B2C business that we have that is keep generating revenue and can grow, somewhere in the ranges of 5% quarter over quarter sequentially. Then we have the upright business that is going regardless of what we are doing on the B2B2C, and we're going to show in Q1 that it's going to grow from Q4 into Q1. And the third part is the B2B2C, which is the employers, the providers, and the health plans that we think are going to contribute a significant amount of revenue into this year. This is why we are very optimistic that one way or another, we will be able to deliver on the numbers that the analysts are projecting, and maybe more than that. And, we'll build our confidence more and more as we move forward into Q2. And now we feel very confident that we're gonna get numbers that are gonna be aligned or even beat the analyst expectations.
Okay, so then if I understand that right, so those deals previously announced, you're saying that's given you guys about between 800,000 and $1.5 million revenue this year. But then how do we make sense of that when we talk about a $600 million pipeline? And I've heard you talk about, I don't know, a 10% close rate or a 20% close rate per year. Which one is it? But either way, if you're talking about 10 or 20%, that's 60 to 120 million revenue. How do you get there? Unless, are there 2 or 3? What's the composition of this pipeline? Is it like 2 or 3 accounts that you think are going to bring in tens of millions of dollars? How do you get to these big numbers?
So there are a few things here. One, there are some contracts that we signed prior to these 3 contracts, like in the middle of 2020 that we are implementing now. One of them we are going to implement at the beginning of April. So the one that he was asking me about was about these 3 contracts that we signed, but we had other contracts that we signed prior to that. That's number 1. Number 2, there are some contracts that we know we're going to sign very shortly that are getting into implementation, which is something that is going to be added to the revenue. So to make long story short, the market understand and was deep diving into 3 or 4 contracts, but we have more than that we either signed in the past or we're going to sign in the very short term, and we know that are going to get into implementation already in Q2. Some of them probably will, educate investors more and more as we move forward.
Okay, so it sounds like that when you talk about a 600 million pipeline, am I right to assume that there's probably a few, that is the bulk of that, like just a handful that represents the bulk of that, or is it more spread out?
It's more like, Rick was talking about like 10% or 15% of the pipeline that can be, let's say, recognized on a yearly run rate in a year. So it's not going to be 3 or 4. It's going to be something that is more in the ranges of 10 to 15 accounts that will have to contribute to all this revenue. So at the moment, we signed some of them, and some of them we believe we're going to sign moving forward into the second quarter. Just one thing that we need to emphasize is that when we are working with health plans and providers, we can sign on agreements off cycle. It means that if we're going to sign something in 2 weeks from now, we can implement it already in Q2. When we sign with employer, in 75% of the cases, we're going to start to implement this employer only in January 2022. So employer is on cycle on 75% of the cases. Health plans and providers are off cycle. So whenever we're going to sign, we're going to start and implement. And if you're going to have, an account of 5,000 or 10,000 users, it's going to make a very big difference to our top line. At the moment, if we are taking our B2C business and the upright business and what we already signed on the B2B plus what we know we're going to sign in the next few weeks, we are very confident that we can make the numbers that the analysts are expecting. If we're going to sign more, then we're going to do more.
Okay, so that's very helpful color, by the way. I really appreciate that. So about 10 to 15 accounts. I'm not going to hold you to these exact numbers, but just to get a rough idea, 10 to 15 accounts is what it would take to close 10% of 600 million, roughly.
Yeah, this is more or less the estimation. It depends on the size. Right. It depends if it's health plans and so on. Usually, right. Health plan is like 5 to 10 times bigger than an employer.
Quick question about health plans, which I never asked you, just an impromptu question. When you sign a health plan, do they market the product directly to their customers? Is that how it works?
In most of the cases, the health plans are operating like employers.
Okay.
We are responsible to do the opt-in.
Okay.
So part of the know-how, and this is one of the things that we were emphasizing on the call, is that we have the ability, we have a very good ability or success implementing the accounts in terms of the enrollment rate. One of the things that we are getting is the license to hunt, so to say. So it's our responsibility to opt in. You can opt in users by email, by SMS, by phone call, or whatever. This is what we did with the employers, and one of the things that Rick stated is that we exceeded the 30% enrollment rate for the employers. And this is something that shows that we, on this transformation from B2C to B2B, we have all the tools in place in order to be able to implement successfully accounts. And the mechanism that is working on the employer, this is exactly the same mechanism that is working also with health plans. So practically, they're going to tell us yes. They're going to tell us we will be able to cover users, for example, for $60 per member per month. And it's going to be our responsibility to opt in users and to enroll them. The more successful we are, the higher revenue we can generate.
And that's very interesting. So is there some sort of direct integration? Let's say customer, they get an email from Dario. Is it going to all be coming from Dario and that they click to opt in? Does it go to the health plan website? Does it go to your website? How does that process work?
Yeah, so it depends on the account. Usually you have like few tools. One of the tools is email. So for example, when we are working with employers, the head of HR is issuing an email to all the employers, all the employees. And then there is a link to a landing page of Dario, and we are interacting with them. For some employers, we are allowed to send the emails. For some employers, we can also send snail email. For some employers, we are getting the phone and we can call them and so on. So there are multiple channels that we are pursuing in order to optimize the enrollment rate. But in all the cases, it's not the responsibility of the employer or the health plan to get us, the users and to force them to use it. So theoretically, you can win an account, but not to generate zero revenue if you don't have the capabilities to enroll. And one of the things that we did in 2020 is building these capabilities of enrollment based on the experience that we brought from the direct to consumer. So, if we know how to hunt people through Facebook or Google or Instagram or whatever, all these kind of capabilities is something that is serving us very well when we need to convince them to embark on a program when they get an email from the head of HR, for example.
Wow, that's great color. I didn't know about that process at all. That's very helpful. So going back to the health insurers for a second, I looked back yesterday and preparing for this meeting at some of the transcripts on the previous calls, and it's been about 2 or 3 quarters. You guys have been very bullish in terms of expressing an imminent signing of health plans. Like, again, next 2 or 3 weeks, we're signing on, health. I think there was probably two of them that you refer to over those quarters. So the question is, what's been the holdup, if it's possible to add some color, and why should we believe you now?
Yeah, it's a very good question. So health plans are very unpredictable. And yes, we had a few of them that were in a very advanced stage. One of them, we were like 99% sure it was already in red lines and so on. and it got postponed because of some internal changes inside the health plans. So, I'm not telling you to believe us now. We are here to run the business and to do it as effective as possible. We do think that we have the right product in hand. We have the right team that knows how to sell into this channel, that proved success in other companies selling into the health plan channel. And I think that we do have the cash in hand in order to crack it one way or another. So we do see the demand for solutions. I can tell you that in other cases we are in a contracting stage, but never say never. So I think that the chances are very, very, very high, but there is no 100% on anything in life. So
right, but it's fair to say that you'd have to get at least one of those health plans in order to get that 10% of a 600 million pipeline. That depends on getting at some health plans, right?
Yeah, I mean, it's the business have so many channels and opportunities, and we have like 3 teams that are working in parallel on the employers, health plans, and providers. So, getting the numbers to scale is something that will happen. Obviously, health plans is a big portion of what we are doing, but we're very bullish on how we can grow the sales, even if health plan is going to be delayed by another quarter, which is, I don't think that that's the case. But we are not, we didn't put all the eggs in one basket. And this is why we're going to see a growth in Q1, and moving forward, we're going to see it also in Q2 and 3. We built our overall channels, including the different chronic conditions that we are dealing with, in order not to be in a situation that we are relying on one channel, one client, or one chronic condition. So the business is diversified in a significant way, and we're going to improve it by getting into additional condition. So yes, health plans is going to be big, but if we're not going to sign on a health plan, in the next 2-3 months, don't think that we're not going to make the numbers of 2021.
Okay, that was perfect. That's what I wanted to know. Okay, 2 more questions for you. On the Q4 call, you mentioned that the pipeline was based on diabetes only. Separately, you mentioned that there's a 10%, I think, enrollment rate for diabetes, or that's 10% is the addressable market. But if you add hypertension, it's 20 to 25%. With MSK, it's 40%. Did I understand that all right? So does that mean if 600 million is a pipeline only for diabetes, once you're up to that 3rd indication of MSK, does that mean the pipeline's 4 times bigger?
No.
Okay, good. That seems.
Yeah. So I think that when you're looking into the pipeline, you're looking into the eligible members. You cannot assume that everyone that is buying diabetes will buy also hypertension and MSK. And this is why you cannot say that it's 3 or 4 times bigger. Okay. I think that the numbers that we were putting out there is that we assume that 15 to 20% of the clients will buy a second condition like MSK, and then we put potential eligible members and so on. And based on what we are seeing so far, talking with potential clients and also clients that already signed agreements with Dario, we think that 15 to 20% makes sense in terms of clients that will embark on the second condition. We also know numbers from other competitors on what is the usual adoption rate from one condition to the second to the third. So we have some sense that this number is not too aggressive, and it's very doable.
Cool. Okay. You mentioned here about getting into an additional condition. I think you also mentioned it on a interview last week. I'm not sure if that was new. I don't remember hearing that definitively, that you're getting into an additional condition when you had the Q4 conference call, but a couple times now you've been definitive about that. So anything more you can tell us about that, or is like, I guess, is organically or through acquisition? It sounds like that's what it seemed like. Yeah.
So we do believe that the market is going through consolidation. We do believe that if you want to deal with digital health and you want to provide a personalized treatment. You must be able to talk with the user on multiple conditions, especially the conditions that are related to each other. So that's a very natural part of what we are doing, and that's something that we will definitely do. There are options to build something by ourselves, and there is an option for acquisition. In any case, whatever we do, we are doing it in a very thoughtful way. We don't want to dilute our shareholders in an unreasonable way. And you know, you are following the company for the last year, you probably have seen that the way that we are raising money is very thoughtful. We are doing it in up rounds and so on. At the moment, we are fully funded into 2023, and we're not going to change this kind of cash balance in a way that will require us to raise more money. We don't want to go to the market. We don't want to raise more money. So it means that either we're going to build it by ourselves, or we're going to make an acquisition that is more like equity and not cash. Mm-hmm. These are the options that we have in hand, and we'll figure out the right option once we move forward. We are very active in terms of looking into other solutions. We are very active into screening other companies and being able to leverage on the capabilities that we have in order to get to the fourth condition. And that's something that we'll try to do already this year. So we are very bullish about that.
All right, great. That's all the questions I had. Is there anything else you wanted to add?
Actually not. And you know, the first question that you asked about the revenues and so on, I got that the market didn't really understand it. So thanks for the clarification. And we'll look for other opportunities to clarify to the market. So that's something that we're going to do as well. So thanks for hosting me, Ben.
Thank you. Thank you, Erez, so much for your time. You can follow Story Trading at YouTube and on Twitter. Erez, good luck on everything. We'll follow you closely, and we'll talk to you again in a few months, maybe.
Thank you, guys, and thanks for all the support. Bye-bye.
Thank you. Bye-bye.